Welcome, and thank you for joining today's conference, Market Surveillance Committee meeting. Before we begin, please ensure you have opened the WebEx chat panel by using the associated icon on the bottom right corner of your WebEx screen. If you have any technical issues, please send a chat to the event producer. Please note that all audio connections are muted at this time until the Q&A portion of the call. With that, I'll turn the conference over to Dr. Benjamin Hobbs, Chair of the Market Surveillance Committee. Please go ahead.
Okay, thank you, Shreev. Yes, this is Ben Hobbs, and I'm pleased to welcome all of you to our meeting, which concerns multi-interval optimization, in particular the operation of storage and some of the interesting things that can happen. We will have presentations from ISO staff and LS Power on in the next 2.5 hours. But before we do that, we have a couple of other agenda items. As usual, in this meeting, we welcome comments from stakeholders on issues facing the markets or questions. So in other words, an open comment period. We also have some minutes that we're going to be considering for approval for August 27th. And then we'll proceed to the presentations by LS Power and the staff. So first, let me introduce the folks who are around the virtual table. So Doctors Jim Bushnell and Scott Harvey are the other members of the Market Surveillance Committee who are here today. Then visiting us from LS Power are Cody Hill, Brian Bartholomew, and Renee Stuyton. And then from the ISO, the staff who are here include, we have Anna McKenna, Fan Zhang, Greg Cook, Rahul Kalaskar, Dr. Guillermo Batista-Alderete, John Gooden, and Shami Davis. Have I missed anybody? Is there anybody else from the ISO staff who's here?
Hey, Ben, this is Gabe Murtaugh. I'm online as well.
Okay, great. Thanks, Gabe. Glad you're here. Okay, so operator, can you please invite people who have a comment or question during the open comment period to queue up at this time?
Sure. If you're connected to the computer audio or use the Call Me feature in WebEx, you may enter the question queue. You may enter the comment queue by using the WebEx raise hand icon located just above the chat panel. You'll hear a beep tone when you're unmuted. At that time, please state your name and comment. If you're just on the phone line and not using the WebEx audio, please dial #2 on your phone to enter the comment queue. You'll hear a notification when you're unmuted. At that time, please state your name and comment.
Has anybody queued up?
I do not see any attendees in the queue. Queued up now.
Okay, thank you very much. All right, we'll go to the next agenda item then, which is the consideration of the 2021 General Session meeting minutes. And a draft of those minutes has been distributed, and I would entertain a motion to approve the minutes. Jim or Scott?
I move to approve the minutes. This is Jim.
Okay, do I have a second? Scott, are you muted?
I'm unmuted now. Something was wrong with the system here, but yeah, I second.
Okay, it's been moved and seconded that the minutes from August 27th, 2021 be approved. Any discussion or corrections?
Not from Scott.
Okay, there are being there no further discussion, I'll take a vote. Jim?
Yes.
Scott?
Yes.
And I vote yes, so the minutes have been unanimously adopted. Okay, so at this point, we're going to go to the heart of the session, which will start with a presentation by representatives of LS Power, Cody Hill, Brian Bartholomew, and operator, can you cue up their slides?
Gabe.
Sorry?
Ben, I was just a couple introductory remarks.
Thank you. Gabe, thank you very much for reminding me. Yes. Forgive me, Cody and Brian. You can sit back down and relax. Gabe, thanks very much for reminding me. Go ahead.
Yeah. I'm going to be very brief, so you can sit down and relax for just a few seconds, and then you'll be on. So, operator, if you could advance the next slide, please. So I'm sure everybody's aware, but I am Gabe Bertaw, the storage sector manager here at California ISO, and I'm overseeing the policy development for energy storage enhancements, which is, the topic that we're discussing today is a component of that initiative. And I wanted to give just a little bit of background to start with on sort of where we are in terms of timeline for that project and that specific part of policy development, and then just a little bit of context on how this conversation fits into other activities that the ISO is doing for other stakeholder initiatives that have already been approved. So just for everybody's reference here, on this slide, slide 2 outlines the timeline that we have for the energy storage enhancements policy. Here's just a few key dates for other activities that we've been doing and working on for this policy. Everyone with good memories may recall that back on May 5th, we posted the issue paper for energy storage enhancements. That has been quite a while ago, but we've been pretty busy in between then and now with activity around these issues. Specifically on July 26th, the ISO hosted an event where market participants were able to participate and present on some potential solutions to the issue paper. And I think we also got some feedback and some expansion on some of the ideas that we had initially presented in the issue paper as well. So it was a great meeting. We did have an opportunity to have comments on both the issue paper and the market participant presentations on that issue paper. And that's all documented as usual on the ISO's website, so you can find that information there, including the presentations from the market participants. On August 27th, we had another discussion with the Market Surveillance Committee. That discussion was primarily focused on this idea about a state of charge product. The state of charge product is something that we considered as one of the things we would be considering as a part of the scope of this project, and that was outlined in the issue paper for energy storage enhancements. The discussion on that around the state of charge product was primarily focused on, sort of the high-level concepts of what a state of charge product could look like. And we heard a lot of feedback from the Market Surveillance Committee and from stakeholders about whether or not the ISO should pursue something like that. And I think that information will inform what we put in our straw proposal around that piece of the policy. Today, October 1st, happy October, everyone. We're at our second Market Surveillance Committee presentation, and today we're talking about multi-interval optimization. This is something that the ISO internally has dealt with quite a bit over the last few months, specifically with storage resources. Just at the absolute highest level, I think a lot of the commentary around this sort of goes along these lines. There'll be a storage resource in the market. It will be bidding in to charge at prices above a certain level. Charge at prices below a certain level, discharge at prices above a certain level. They'll see some prices materialize in the market, and their dispatch instruction for that specific interval won't necessarily align with the bids that are in place for that hour. And part of the reason that could potentially happen is the multi-interval optimization, because the ISO markets, particularly in the real time, aren't necessarily considering just one specific interval and what the prices are for that one interval. We're considering one binding interval as well as several advisory intervals in RTD. It could be 12 advisory intervals. And so you're looking at essentially an additional hour. And there could be some conditions, and Rahul and Guillermo are going to get into this, that could cause those seemingly anomalous dispatches from the ISO. So that's what we wanted to talk about today. I think this is an appropriate discussion, and it's going to help inform how we develop policy and some of the commentary on generally how storage resources are operating and are optimized within our market. I would also just point everybody's attention to October 28th and ask that if you're interested, you mark your calendars for this. We are planning to have a meeting here hosted by the ISO. It'll be another virtual teleconference meeting where we're titling it a storage forum, and the topic is specifically on markets of the future. But in that meeting, we are actually bringing in a panel of storage industry experts and academics from across the country to think about sort of where we are today in terms of storage development and greenhouse gas reduction goals, specifically here in the state of California, but also more generally how sort of these changes in our markets are applicable and might evolve for all organized markets across the country. And I think it's more taking a step back from thinking about storage in terms of, hey, how can we improve this model to make it work a little bit better for the resources that we have on our market, to more asking the question of, gee, when we have a heck of a lot of storage on our system and it's not just, 4-hour lithium-ion batteries, but a mix of all kinds of batteries, including short duration, long duration, multiple technology types, how are organized markets and price formation going to change in the future, and what sort of changes might we anticipate, and how do we get, how do we progress our markets to get to a place to be able to deal with that with deep penetrations of storage resources and renewables, like we're anticipating with the state of California's greenhouse gas reduction goals, those kinds of things. So it should be a very interesting conversation, and that will be a panel of industry experts, and Dr. Ben Hobbs from the Market Surveillance Committee will be chairing that storage forum as well. And I think we're also going to be getting some kind of, first, we will have all the presentations documented, and we'll put those on the California ISO website. And second, there will also be some kind of a written documentation of sort of the findings and some of the big thoughts from that meeting. We'll also publish that on our website as well. At the conclusion of that meeting, sometime in October, I am hoping to publish the straw proposal for energy storage enhancements. Like all ISO stakeholder initiatives, there'll be multiple iterations of the straw proposal, eventually concluding in a draft final proposal and then eventually a final proposal. And the idea would be to get that wrapped up sometime in 2022. I think right now we're thinking about a third quarter of 2022 date to go to the ISO Board of Governors for final approval of this policy. Obviously, that's quite a bit in advance of where we are right now, and there's a lot of work to be done in between then and now. But that is sort of our target date at this time. Operator, if you could advance one more slide, please. So while we are working on sort of the next generation of policy for energy storage enhancements, We also have quite a bit of policy that we've developed over the last few years that still needs to be implemented. I think this is important to think about in terms of our conversation today, because as some of this policy is developed, it could impact things like bidding and scheduling for storage resources, which could play a role in changing some of the outcomes that we're talking about today. So specifically, there are two pieces of policy, so ESDR 4 and the Hybrid Resources Initiative, that still have not been implemented. And for the Hybrid Resources Initiative, some components have been implemented, but everything from phase 2 and some of the additional aspects, such as the aggregate capability constraint additions, have not been implemented at this time. So for ESDR 4, we are targeting a fall 2021 software release date. Currently, the ISO is anticipating that this software goes live on November 1st. I know that there's still quite a bit of testing to do, and a lot of the software development people here at the ISO are focusing on that project. So I think the date is somewhat fluid, but right now we are currently targeting November 1st. Changes for ESDR 4 that will be included are the application of market power mitigation for storage resources and the availability for storage resources to use a new default energy bid called the storage default energy bid. These are particularly relevant to our conversations today because occasionally we do see storage resources bidding at very high levels. In the future, if those storage resources are bidding at those high levels and they're not above, in the real-time market, if they're not above opportunity costs for that day, then they could potentially be mitigated by market power mitigation measures that the ISO has in place. And to the extent that that happens, there could be, potentially another layer of complexity on, these resources bid that we'd also have to consider. So that's something just to keep in mind. Also from ESDR 4, there will be additional parameters that are biddable by storage resources, specifically the end-of-hour stated charge parameters that can allow storage resources to specify at the end of a particular hour what a maximum or potentially a minimum stated charge for that battery could or should be. And the market optimization in the real time will work to keep those batteries within those parameters that are specified in the end of the market. For hybrid resources, we do have some changes coming in fall 2021. This list is by no means exhaustive. These are just sort of the big ticket items. We've got the high sustainable limits for hybrid and co-located resources coming in the fall. And then in spring of 2022, we do have the hybrid dynamic limit tools going into place. So this will not be in place in November. It's something more along the lines of March or April 1st, 2022. But in my opinion, I think the hybrid dynamic limit tools really are what make the hybrid model workable for a lot of different resources that we're seeing online today that may want to employ this model. So sort of a sneak peek on what's coming up and some of the work that we've done over the last few years. With that, if there are no questions, I will turn it back over to Ben. Operator, do we have any questions in the queue?
I do not see any questions in the queue as of now. As a reminder, if you're connected to the computer audio or use the Call Me feature in WebEx, you may enter the question queue by using the WebEx raise hand icon located just above the chat panel. You'll hear a beep tone when your line is unmuted. At that time, please state your name and question. If you're just on the phone line and not using the WebEx audio, please dial #2 on your phone to enter the question queue. You'll hear a notification when your line is unmuted. At that time, please state your name and question.
Okay. Any questions for Gabe from the audience or comments? If there are no questions or comments at this time, Shreya, I think we can then move to the next presentation, which is by Ellis Power. And I'd like to welcome Cody Hill and Brian Ptolemy, as well as Renee Steichen, who will be available for questions and comments. And Cody will be starting the presentation. All yours.
Thank you, Ben. Can everyone hear me? Great.
Yes.
All right. Hello, everybody. This is Cody Hill with now Rev Renewables. We are in the process of launching a new clean energy only company and rebranding. All of the people and projects that have been participating at CAISO as LS Power are going to be submitting things under Rev Renewables going forward. So this was probably the last time you'll see our old letterhead and PowerPoint deck. But we appreciate the opportunity to speak to this group today. These are issues that we have been dealing with in CAISO. We brought on our first large battery in 2018 and have been getting a lot of experience with the dispatch of batteries in the CAISO real-time markets. And these are issues that we have raised and submitted comments on previously in ESDR 2, 3, 4, and the current storage initiative. So we've been going at this in a lot of forums for quite a long time, and we appreciate the chance to present to the Market Surveillance Committee today. I think this is really the group that can dig into these types of very nitty-gritty technical questions about the functioning of the market algorithms. Can you advance the slide, please? So to set things up, I'm going to go ahead and give you guys the general overview of what we see with battery storage resources and specifically how they are affected by multi-interval optimization, give you kind of the higher level version and also what we think the business impacts are to us as a result of the way the multi-interval optimization algorithms work. We'll just call it MIO for short going forward. And then Brian Bartholomew is going to give the specific examples of some of the things that we've seen on our actual assets in the market recently. I'll preface that by saying that the examples we're showing are kind of the cleanest examples and the easiest to look at and say, this doesn't seem quite right. They are not the examples that we think have the largest dollar impacts. So I think it's more of a question of focusing on whether this is the way we want the market to function or not, or rather than are we asking for a few dollars for this particular day? We are not. We know that this is how the market is functioning as designed. I think is the way CAISO likes to phrase it. Is that design the way that you want it to be designed going forward? Is the question to keep in mind. So as Gabe very accurately described, multi-interval optimization is a fundamental part of the real-time energy markets. In the real-time market, CAISO resources are not strictly dispatched according to either their bids and the binding interval prices. They are dispatched according to an estimate of future prices. So a horizon of advisory prices is the way it's described in the tariff. And turning binding interval and advisory intervals into more plain English, the binding interval is the actual price, the one that resources are settled against, and the one that you can pull on CAISO's website or on Oasis. The advisory prices are guesses of the future, and sometimes those guesses are accurate, and other times they are not. That's the nature of guessing about the future. In theory, for storage, this should be helpful because hopefully CAISO is getting us set up to do better based on things that are coming in the future that we don't know about. And certainly we'll be the first to admit that for traditional generators, gas plants, hydro plants, slow ramping, long startup time resources, MIO is very helpful. It's a good part of the market for those resources. However, I think the MIO aspects of the real-time market were kind of blanketly applied to energy storage, potentially inappropriately. Battery storage in particular is just completely different from those types of traditional generators in some key ways that make for unintended outcomes when the MIO algorithm is giving us modifications to the awards compared to what we would think that just the prices in our bids and the actual prices that appear in the market would have delivered. So in practice for storage resources, if you can please advance the slide. we find that multi-interval optimization in practice creates additional risk for the battery projects. The MIO process can lock in losses at the binding prices because it anticipates future prices that are either very high or very low and that never materialize. What we see in practice is that resources are sometimes discharged to make room for projected low prices in the future. If those prices don't materialize in the future, we're stuck with a battery that's at a lower state of charge, and also it was discharged at a lower price than we wanted to sell energy for. We view that as just a generally very negative outcome. Additionally, we even more often see that if there is a high price in the real-time market, say the price is going to go high for 5 or 10 minutes, during those times we may be held back and not discharged, even though we are available and have plenty of energy in the tank and have bids that support a discharge, because the advisory interval predicts even higher prices coming at a future interval, and then those advisory intervals never occur. So there are lots of times where a battery earns less in the market than we think it should have and could have had the CAISO strictly dispatched the resource according to the prices that it bid into the market. So implicit in all of that, MIO can and does dispatch resources outside of the bid curves that are submitted by the battery storage operator when it sees a potential better opportunity ahead. Now, this is something that is it happens with the strongest and most noticeable effects when the duration of the energy in the tank is limited. Another way to say that is if the battery is almost full or almost empty, then MIO is going to begin looking for spreads rather than looking at dispatching the resource according to its marginal cost. This spread bidding is not really an actual thing that was implemented. It has been discussed at a lot of stakeholder processes, but it's worth saying that this is kind of a emergent functioning of just the math of MIO that happens when the resource is somewhat near the either full or empty part of its usable state of charge range. It's not the intention, I believe, of the folks who wrote the MIO algorithms to begin with. So, as I stated, the MIO algorithm does introduce risk for these resources. It dispatches us at prices that are outside of what we are trying to be dispatched at. And in our experience, it performs most poorly, or at least most with the most volatility, really at the worst times. And so when prices in the market are most volatile, that is the times when the advisory prices, one would assume, have the largest errors in them. And ultimately, we see that on days where there is a lot of volatility, whether there was a missed solar forecast or units that have tripped elsewhere in the market, those are the days where we start seeing really bizarre dispatches where we are, discharged prior to the evening peak, for instance, at prices that are too low, or held back during the highest prices of the day. That is exactly the time when you would not want the algorithm to be dispatching the resource in a way that does not necessarily make sense, but it is what we see in practice. It has been raised in the ESDR and energy storage enhancements stakeholder initiatives that the vast majority of the time resources are dispatched according to their bid curves, and that is true. However, the times when we are not dispatched according to the bid curves are frequently the times when you would most want a battery to be able to get full and deliver into the highest prices, which indicate the highest need from CAISO during the day. Can you advance the slide, please? So that's really a description of the day-to-day just operational impact that we see with these resources. But what does it mean from a policy perspective and to the resources themselves and to companies like us who are investing in building battery energy storage projects? Specifically, we're concerned about a few of these things above all, and I've mentioned the first one already. Resources getting discharged early or prevented from charging prior to the evening peak. that is something that creates substantial operational risk for us as the resource owner. We are frequently, especially if we have day-ahead awards, we're on the hook to deliver during the evening peak, and we do not have confidence that we can get full by having CAISO follow our real-time bids. And we really don't have any other levers to pull as far as managing our resource in the market other than submitting bids that indicate our costs and our opportunity costs. So this is a very big concern, and ultimately it does create a level of risk that reduces storage's ability to hedge LSC market exposure, because you can't count on being dispatched during the high prices. So it makes storage less valuable as an asset to hedge your market exposure with than a gas plant would be. If you're an LSC at a CCA or an IOU, you should be looking at this and saying, I want this to get fixed so that I'm incentivized to, hedge with storage projects rather than hedge with gas projects, if you are so motivated to be trying to bring on more storage projects. It does disincentivize further investment in storage in CAISO, in our view, because we are not able to hedge as effectively with these resources. And hedging, the reason I keep focusing on that word, those are the types of contracts that can be locked in for several years, that you can finance against, that kind of completes the revenue picture for energy storage beyond the resource adequacy contracts that pay for part but not all of the storage that is being brought online today. So we consider this a major problem that could potentially hurt California's ability to bring on the very large quantities of energy storage that are in the CPUC's IRP plan and that CAISO is planning for. So back to the short list, the resources not being discharged when energy is needed most. I mentioned that previously. We do have very specific examples of that, lots of them. If there's a single 5-minute high price in a day in the real-time market, frequently it's the case that a battery storage resource will not get discharged into that high price because of advisory intervals. And what we have seen as a result of, I think, both of these things, but really more the very first one, is that on days where there is a lot of activity that appears to be MIO-driven dispatch of battery projects, we are more likely to get exceptionally dispatched. So the CAISO operators are sitting at their desk, they're watching the storage get dispatched through the day, and they will stop and say, okay, this resource is not full, we're almost to the evening peak, we're going to pull it out of the market, we're going to make it charge and sit there and be full and ready for us whenever we want to use it. And that removal from the market in this exceptional dispatch type scenario is inefficient and undesirable for everybody involved. Resource owners and CAISO should all want to minimize the occurrence of that. And we have seen several days where you can draw a very direct link to bad outcomes on MIO, leading to our resources being removed from the market by the CAISO operators for the rest of that day. And that's just something that's, I think, obviously not in line with CAISO's preferred policy outcomes. Can you advance the slide, please? Okay, so just a little bit more here. We're getting pretty close to the actual examples, which are going to be much more interesting than me talking. The way that storage resources and really all generation resources are dispatched in the market, of course, is that you get a day-ahead schedule, and then that schedule becomes your starting point for the real-time market. But largely, the day-ahead and real-time markets do not talk to each other. There is a financial link between the two, but the resources that do not have ramp rate limitations, such as battery energy storage, can really get dispatched according to a completely different shape of megawatt output over the course of the day than their day-ahead awards if the real-time market turns out with very different outcomes. And so we do see that there's some significant difference between how the day-ahead schedule looks and how the real-time outcomes actually are for the resource. Now, the real-time market, that all being said, that's all to set up the issue here, that if we get day-ahead awards, which is always the stated preference of CAISO to try and get as close as they can to their preferred dispatch for the day through the day ahead awards, and then just to use the real time as a, largely a balancing market to make sure that we get exactly the balance of supply and demand that's desired. Those day ahead awards cannot be backed with full confidence by a battery storage resource because of MIO. When it comes to the actual real-time market, let's say you've got an award for 100 megawatts of discharge for an entire hour in the day ahead market. We can submit our bids and tell CAISO, please discharge our resource for, almost any price in order to make sure that we're getting that 100 megawatts out. But if CAISO sees some volatility in the advisory intervals, they may not discharge our resource at 100 megawatts, and they may lock in losses between the day ahead and the real-time market because they are trying to optimize just within that window of real-time binding and advisory intervals. And so the interaction between day ahead and real-time is really a core concern for us, and the thing that I think is the underlying biggest concern when we talk about the ability to use energy storage resources to hedge market exposure for LSEs, because day ahead is where pretty much all of the hedging activity takes place in the CAISO market, and where people do try to get their supplies right. Additionally, this is a little bit complex to understand, but again, the only way that battery storage resources can affect their operation in the market is by bidding in their economic bid curves. We do not have somebody with their hand on the controls saying charge now, discharge now. CAISO dispatches us, and we follow the CAISO signal as closely as possible, and that's a requirement. That's not something that anybody wants to deviate from. But the only thing that we have to do to tell CAISO when to charge and discharge us is our 10-segment economic bid curve that provides prices at which we are willing to be charged and discharged. Now, because of MIO, that one tool that we have gets thrown out the window effectively whenever CAISO sees these corner cases where either state of charge is running out or there's volatility in future intervals. And so it does mean that battery resource owners do not have control of what prices their units are operated at, and this is a fundamentally, it increases risk on battery storage owners. It decreases our ability to be confident that we are going to get dispatched at prices that pay the bills for these resources and that incentivize us to build more of them. Next slide, please. And my last slide here, this is kind of a larger subject that maybe we come back to outside of it, but bid cost recovery, due to the way it is implemented, does not currently in practice make us whole for these types of events. Bid cost recovery as implemented, you have to lose money over the course of the entire 24-hour day pretty much in order to get made whole for something, whereas we see lots of little MIO events throughout the day reducing the battery's revenue, but not adding up to a actual negative loss for the entire day, and so we do not end up being compensated for these events. If that event that I've described a couple times now, where a battery is not discharged into the highest prices of the day, even though it was there and available and it had a supporting bid curve occurs, you are not made whole for that. You just get whatever you get as a function of your dispatch and the current prices. BCR is a very complicated subject. I don't know that today is the time to get all the way into it. But because of all of this, we have seen on net, even though MIO should in theory help resource owners by dispatching more optimally than would be the case without it, we mostly see that it reduces our revenue on the average day in a way that is random and unpredictable, and it is uniquely damaging to storage resources. The algorithm works great for hydro, it works great for gas. We're former owners of many resources in California that we do understand why it is there and how it benefits the overall system. but it is not appropriate for storage. It was not designed for storage, and it reduces the value of storage in the market. So that is the end of my general comments and setup. I think we've got Brian Bartholomew is going to provide some specific examples. Maybe we should pause and take any questions, and we can do 2 rounds of questions after the specific examples.
Thank you, Cody. Yes, this is Ben Hobbs, Chair. Let's first see if there are any questions from the MSC, and first I'll ask on the very last point, the concern about adversely affect its ability to deliver energy in the evening. Does the ending state of charge provision of which is going to be implemented this fall from ESDR 4, would that take care of that concern where you can specify the ending state of charge at a particular time, and the ISO can move you around before that, but will hit the state of charge so that you know that you have the energy of the evening if that's what you want to have for sure. So does that take care of that worry?
So I'll say I am a fan of that that change and that addition to the CAISO market in general. I do not think it addresses that particular issue very well. So specifically on that, I think the goal of getting full prior to the evening peak hours, if you've got that day ahead charge or the day ahead discharge scheduled, that is something that this upcoming product appears that it should be, useful for. I think it's kind of a forcing function to get CAISO to fill you up if you need to be full. However, I think outside of that very specific example, and I should also say actually that there's another large debate, of course, around energy storage resources and the minimum state of charge requirements that have been discussed in energy storage enhancements and elsewhere. I think this tool pretty much solves that problem, which has been a top concern of Gabe and the team at CAISO Policy, and I understand from the operations and engineering teams as well. So I do think that's a very valuable tool for that. However, it would not help us be sure that we are getting discharged during high prices. It would not really ensure that we are getting economic outcomes where our resources are getting discharged for the high prices and charged for the low prices. I think we still see that MIO would have the ability to dispatch us, at any megawatt level at any random price if there is volatility in the advisory intervals that are predicted ahead. So, it's a yes and no to your question, I think, Ben.
Okay, that's helpful, Cody. So I'll ask one other question to pass the baton to Jim and Scott. So I think what I'm sensing is that the issue is not so much that you don't like MIO, but that the advisory prices you feel are untrustworthy, introduce risk, and in fact introduce so much risk and are so unreliable that that they lower your profitability. Because I unless I'm mistaken, I don't think there's any doubt that given your offers and bids for discharging and charging, which have to be set well ahead of real time, the advisory prices are going to be closer to the moment and should be more accurate estimates than what you had when you set your bids and offers. If advisory prices were 100% accurate, if there's no error at all, then you can show that you will earn more money by following the MIO instructions than by being dispatched according to just your binding interval bids, that you would be leaving money on the table. If that is indeed the case, subject to the minimum state of charge being met at the end of the real-time dispatch horizon, If that's the case, then it's really the uncertainty, the fact that the actual later binding interval prices deviate from the earlier calculated advisory prices. It's those deviations which cause you heartburn. And I think I'm even hearing you say that the advisory prices are so poor or so error prone that that you're not making more money by being dispatched according to MIO on average over many days, that you're actually losing money. And I'd like to confirm that that's indeed the way that you see the situation, that MIO is causing you, on average, over the longer term, to lose money, rather than, as designed, it should be making you more money. And I'd be very interested if you have calculated the profits you would have earned over all days, rather than, a few anecdotes that you're upset about, but over all days, whether indeed you would have been better off being dispatched according to your binding interval offers and bids, rather than according to MIO. So in a nutshell, is the issue the errors in advisory prices rather than MIO inherently?
Yeah, really good question. First, to confirm, yes, we do think that overall MIO does reduce the revenues and profits of battery energy storage resources. We are quite confident about that, having now 4 years of experience of running batteries in the market. Unfortunately, there is no good way to calculate over all days what your outcomes would have been, and a part of that has to do with batteries providing some amount of ancillary services in a number of hours and a lot of days, and that really randomizes the dispatch, and so it's hard to predict what would have happened had a different thing happened in one of the several markets we participate in. So unfortunately, I don't think there's a good clean answer to your question of what you would like to follow up on there. But yeah, on the days that we have been energy only and not participated in ancillary services, yes, we have overwhelmingly seen that it costs you a few $1,000s a day to have MIO operate on probably the median day. There are occasional days where there is very little volatility, prices are very flat, and maybe a resource would have made $0 because prices just never got to where its bid curve was, and maybe the MIO makes it $1,000 or something like that, but that is nowhere near outweighing the severe events that we see, especially on the days with a lot of volatility and with very high prices. And that's even before we get into all of the reliability questions that I was raising before, where if CAISO's MIO algorithm has the resource at a low state of charge, we get an exceptional dispatch, right? We get kicked out of the market for the entire day. And that amount of risk is something that is fundamental to MIO, and I do not think that it gets fixed by having perfect advisory vision. I don't think that having perfect prediction of the future is even a feasible thing that anybody thinks is something that's on the horizon for CAISO. So yeah, in theory, you are right. If perfect foresight of the future was possible, the advisory intervals would benefit battery storage. But in practice, MIO hurts battery storage and reduces revenue and creates an unnecessary operating risk. We're happy to follow up on that.
Okay, Cody, thanks. Would you go so far as to say then that you have not seen times when the MIO has dispatched you out of merit and you made more money as a result? Or, and you said afterwards, boy, I'm glad we were dispatched out of merit because we got more money than had we been dispatched according to our bids and offers.
I would not go so far as to say that, and I think I just said or tried to convey in the previous statement that we have seen individual days where there's small benefits. Maybe there are no particularly high prices, but CAISO still gets us to discharge a little bit at the prices that do prevail, and so we make a few dollars where we would have made almost none. But these are small dollars and do not come anywhere close to tipping the scale to where we are in favor of MIO.
Okay, thanks. Jim and Scott. And any questions or comments before we go to the phone lines?
This is Jim. I just wanted to maybe frame the previous discussion. So yeah, I think where Ben was going with the perfect foresight idea has to do with trying to get a sense of how much of this problem is maybe a bias in the advisory price versus just sort of the natural volatility. There's going to be errors sometimes. And I think from this discussion, what I got out of it was, I think it would be helpful maybe if we can revisit this as you go through the examples as well, because you said that during periods in which prices are more or less flat, the MIO is perhaps more helpful than not, but it's the periods where there's a lot of, and I wasn't quite sure if that meant just volatility in an unpredictable way or even in a predictable way, but there's a lot of volatility, that's where you really seem to feel the losses. So it seems from that description, what I'm taking from it is that there are maybe the median hour MIO is perhaps helping you, but that when you do see the periods in which it's not helping you, that's related to the fact that there are these extreme price swings, and that is sort of tilting the losses to overwhelm the gains at least in your sense. I'm not sure how far you've gone into kind of completely quantifying that. So that's what I took from the discussion, and if true, it's sort of interesting to sort of focus again on that as we go through the examples about sort of how that story sort of plays out in these examples. I'm not sure what it means for MIO design at this point. That's it.
Okay. Okay. Thanks, Jim. I don't know, Cody, if you'd like to have any response now, or we can continue.
It's not really a question. It's just sort of like my reaction to that discussion, and I think seeing how that exchange is perhaps reflected in examples, although I'm not sure if we're seeing examples of where it works. That might be helpful as well.
Right.
So if I can just respond to that very briefly, I think the actual operation of battery storage resources is not that complicated. You want to get full and be full and ready to discharge into the high prices, and that's overwhelmingly the goal of our bid curves when it comes to the energy market specifically, right? I think the actual trying to charge at the absolute lowest prices is not really that important for battery outcomes, just because high prices go so much higher. They go to $1,000, whereas low prices only go from, let's say, $30 to $0. And because of that, we are able to capture or to be there and be ready to discharge into almost all the high prices. MIO does not really capture a lot of things that our bid curves wouldn't have captured already in the market. And so that's why I'm saying the days where we can see a measurable beneficial impact from MIO are days with no high prices. And by definition, those are days that are not meaningful to the overall returns of battery projects. We have looked at days, really all days where we've been energy only, and seen that on the median day, taken as the full 24 hours, we lose money from MIO, a little bit of money. But again, the median day is not very important. We're mostly concerned about the big days where there are heat waves, price spikes, outages, those sorts of things, where we see the worst outcomes and where we're least confident that our resource is able to hedge market exposure because of the high likelihood of either MIO activities and or exceptional dispatch that removes us from the market.
Okay, that's helpful. Yeah, because I guess what I was trying to imagine is that there might be certain intervals where MIO is predicting a price spike that maybe you did not see coming, and in which case perhaps there would be a better gain resulting from MIO. But I guess there's an interaction with the bid curves here as well, which is what you're saying, that that sort of limits the upside that the scenario I just described could give you. That and the fact that, yeah, as you say, the prices are bounded in a certain way. So that, yeah, that's helpful. I'm still processing what it means at a high level.
Yeah, exactly. If there's a price spike coming, chances are we were already full enough to hit it if they just followed our bid curves. So that's not a gain to us, right?
Okay, Scott. Scott, do you have any questions or comments at this time?
No, I think I'll wait. Let's go on.
Okay, great. We do have several people queued up on the phone line. So Shreya, could you take the first question, please?
Sure. Caller, please go ahead. Your line is unmuted. Before unmuting the line, I would just like to remind that you'll hear a beep tone when your line is unmuted. So after that, you can go ahead and state your name and question. Thank you. Caller, your line is unmuted. Please go ahead.
Hey guys, this is Mike Castellano from the CPUC Energy Division. I just want to say that I'm really concerned about how far this has gotten. What I'm hearing from LS Power is that they have energy storage resources. They use these things to sell some kind of price hedges to LSEs and to back up those hedges. And they're bidding in a way that's not really profit maximizing to just exist in the energy market. And that they're, with those bids, they're not making enough money to keep going. The idea that we're going to change the energy market to help make money off of price hedges is, a little bit, seems, pretty far out there to me. And I'm not seeing I don't really see the issues here. I am really just hesitant that any of this is any kind of real issue, just because it really sounds to me like people are not actually engaging in a profit maximizing bid strategy here, and they have other motives for their bids, which may be totally fine, but I don't think that's not our goal for designing the energy market. And the complaints about BCR not making you whole for profits that you could have made under alternate circumstances, that is a little bit, that kind of stuff happens to all kinds of resources that are, ramped or held back at various times based on advisory prices. And so, there's definitely, that's not necessarily as exclusive to storage as we might want to think. And getting rid of or changing the MIO, I don't see how that's going to have any impact on exceptional dispatch. I think that'll increase exceptional dispatches if this system is not sort of planning as far in advance as it can for the operation of battery storage resources. And we've been hearing these issues from LS Power for a while. I still haven't seen any concrete evidence of it. When I've talked to people who've looked at the data, I get different stories than I hear from LS Power. So I'm just really confused at what's going on. And I think, we really need to, if we're going to talk about this seriously, we need to dive into it a lot deeper than this.
Well, I think, Mike, that's the point. That's what we're going to get to in the next slide, is get some really concrete stuff to talk about. And then I think we can come back after and then, Rahul and Guillermo are going to dig into and give us some insights into what's happening. So that's the more important part of today, I think, is getting into the specifics.
Can I just address one thing that Mike just said, though? I mean, Mike, I think you betrayed just a fundamental misunderstanding of the purpose of hedging and how resources contract with LSEs here. So the way in which a battery project is paid for, and you should know this being at the CPUC, is a combination of resource adequacy and energy market revenues, right? That is very straightforward, very fundamental. Resource adequacy does not pay full freight for building a new storage resource, just full stop, right? The prices, you have access to this information, at which RA deals get done is not sufficient to build a battery storage resource alone. So in order to maximize our ability to invest in this market, to build energy storage resources, we have to sell energy products. And the type of energy products that you can tank to a bank and get project financing on are long-term contracts. You cannot take, hey, I've got 200 megawatts of CAISO merchant market exposure coming up for the next 20 years. Loan me money at an attractive rate that's going to get something built. That is not how you get infrastructure projects built. The way you do it is by going out and lining up energy deals, and we need to be able to back those energy deals that cover the exposure that LSCs have in the market. To the degree to which MIO helps us cover the exposure that LSCs have in the market, then those LSCs will want to do deals and we will be able to build more projects. To the degree to which MIO prevents us from getting dispatched at the high prices and covering those LSCs' risk, we are disincentivized from investing in energy storage, and the whole CAISO and CPUC IRP plan for getting 10 gigawatts of storage on is undermined. So I really do not appreciate the insinuation that we're trying to needle the market for extra dollars here. We are not. We are trying to improve its overall functioning so that we can invest hundreds of millions of dollars more in building more storage that California desperately needs. So I'll thank you not to be so insulting like you have been on several of these calls.
I'm not trying to insult anybody. I'm just saying that the bidding strategy that you portray is not one of maximizing profits in the energy market.
Wrong.
No, that's what you just said. You just said that you guys are selling other products, and I understand that you're saying you need to sell products. Okay.
You did not understand it if that is your takeaway.
I would really ask you to be a little more, take your tone down a little bit. I'm just trying to talk. I'm trying to explain my position, and I don't appreciate being cut off and basically yelled at right now. So I don't really know what's going on, but I guess I'll just stop.
I apologize. This is not the first time we have had this conversation, Mike, and I really do apologize for my tone. But
okay, but
you can take this offline.
All right, I don't know what else to say at this point. Thanks.
All right, I guess we'll go to the next. Question in the line. Mike, thank you for joining us, and I do appreciate your input. Shiv, who's next on the phone line?
Sure. Caller, please go ahead. Your line is unmuted.
So are you all focused in a specific area or region, or want to focus in on one for call?
Hi, this is Drew Gray with EDF Renewables. We have an NGR there in the CAISO that we are currently operating in energy only mode, and we generally concur with the issues that Cody has raised here. One of the things that I wanted to point out is that given the structure of the MIO and being a time-coupled dispatch across all the intervals, and the use of only a singular interval within that optimization, even if the forecast of the ISO is 100% spot on, you don't have certainty that for intervals in which there are binding either ramp constraints or SOC constraints, any constraint across time, you're not going to have pure certainty that the shadow price impact is showing up in the very first interval. Generally, that shadow price is going to have duals all across the time frame, such that the shadow price of that impact of holding back or start ramping early could show up in any of those intervals, but by only having the very first interval binding and not cascading your settlement across every single interval within that optimization, you lose all of that binding shadow price information because you're only taking the first one and you don't necessarily have that. And that's an inherent flaw in how this settlement and the whole getting the best impact of this multi-interval optimization would truly pass down. Otherwise, the ISO's forecast error out in time just provides extra uncertainty that makes it hard to handle just the way that the market's currently designed. But that's all I wanted to point out is that even with perfect foresight, you're not going to guarantee that the pricing in that first interval is appropriate.
So yeah, this has been, so you're not implying that the prices are incorrectly calculated. It sounds like you're saying it's just hard to predict how the constraints will interact and the shadow prices will propagate. So
correct. It's a natural function of a time-coupled optimization, especially when because that constraint is usually across multiple intervals binding, and a lot of times when these things solve, you're only going to see that shadow price show up in one of the singular intervals because it has a dual solution, whether that entire shadow price shows up in one interval versus spread across all of them that are binding in that for whatever given constraint it is. And so you're not going to have there is no guarantee or even close to certainty that first interval is going to have all of the price impacts because it could be spread around on any of the intervals in which the multiple interval optimization is bound on any given constraint.
Well, the way I would interpret that, Drew, is that the knife edge nature of many of these constraints means that small amounts of uncertainty can result in large changes in shadow prices in particular intervals, and so this adds to the uncertainty. It's not that you're saying there's something fundamentally wrong in how they're calculated.
Correct. It's a flaw in how it's settled because it's only settling against one interval of the optimization.
Are you implicitly proposing that we should have multi-interval settlements that would take care of the issue? That if we're holding back energy to sell it later, well, you should pay for that now. Is that what you're saying?
Yes, that would inherently fix the issue because then you would be getting settled against that higher price in the future that the ISO's forecast is foreseeing. Now, is that kind of settlement feasible? I don't. My knowledge, and it's a bit deep in these Siemens and GE settlement systems, is that it's probably not feasible to do. To do a cascading settlement across all the 4 hours in real time continuously, it's going to be difficult. But yes, that should fix this type of issue.
Okay, thanks, Drew. Anybody want to respond to that before we go to the next question?
Scott Irving doesn't agree, but I think we're way off point. I'd like us to focus on the original issue here, and if we want to come back and talk about the multi-interval prices, I think the issue is it's actually less of a problem when you have uncertainty, and it appears to be a problem when you have these knife edge solutions. But I'd like to focus, to get the guys from LS Power to talk about the example, and Rahul and Guillermo to talk about it, and we could have other sessions for these other issues.
Okay, thanks, Scott. Triv, do we have somebody else on the phone lines?
I do not see any further callers in the phone line as of now.
Okay, thank you. Okay, Cody, thanks for the overview presentation. I think, Brian, you're going to be stepping up to the mic now.
Brian, can you please unmute your phone line?
Sorry, I unmuted the phone and not the computer. So what we're going to do here is just walk through a recent MIO example that hit 2 of our batteries on a recent summer morning, where it's just pretty clear cut. And we've been talking about it abstractly, but to give everybody a feel for what it looks like. And looking at the deck Kaiso posted, seems like they also went through this example, so we're going to get to see it from their end as well. And obviously really appreciate all the work on Kaiso's end, digging in and trying to unpack what's going on. Can we jump forward 2 slides, please?
You mean 2 slides backwards?
Forward, please.
Okay.
Yeah, so we're looking at here, we've just got a table across 2 hours, recent morning. So first column is just going to be the real-time LMP at this battery. So that'll be bucks per megawatt hour. The middle column there is going to be the dispatch. So positive numbers means being discharged. Negative numbers means being charged. 0 means held to do nothing. And then on the right, just reference how many megawatt hours the plant had in the tank. And what'll jump out to you here, right, if you're looking at this string of real-time prices down that left column, you'll notice that, in the highest price of the day, this battery is completely held back, dispatched to 0. According to its bids, it should be outputting over 200 megawatts. So like we've been saying, you look at some of these less volatile prices earlier in the day, we're being dispatched according to our bid curve. MIO is quote unquote working. But when we get to these really volatile periods, it starts to produce some outcomes that from our side don't look optimal. And if we can jump to the next slide. Yeah, so you'll just see here, right, the highest price interval of the day, the battery's held back to do nothing, and then ends up discharging, pretty suboptimally into lower prices that follow. And what we think is happening here, right, is the advisory prices are maybe looking out and saying, in 7 o'clock, 7:10, 7:15, we could be seeing, $500 per megawatt hour, $1,000 per megawatt hour prices. So they're holding us back against our bid curve, not discharging us into the highest price of the day. And then when those higher prices don't actually materialize, we've just missed out on an opportunity, and there's no real compensation for it. And again, right, our bid curve is really the only thing that we have to control dispatch. So when MIO puts us outside of that, it just really reduces our confidence in getting the good dispatch that we need. And you can imagine, this was a morning and we didn't have day-ahead awards in this instance, but seeing stuff like this makes it much more risky for us to want to sell, energy day-ahead as Kaiser prefers, because we're worried that we can't back it in real time. If we can jump to the next slide, please.
Actually, can we stop? And I'd like to make a couple points about this. This is Scott Harvey. Because I think this is a great example, and there are a couple things I want to highlight that you didn't focus on. If you go back to the previous example of the battery 1, first I want to point out that this is a really interesting example because the tank is not empty. This battery has a lot of energy. If you look at that third column, plant energy, it's got quite a bit of energy left. So it wasn't as if, we're empty and we got to stop charging because we're almost empty and we got to stop charging because there's a really high interval. It's got quite a bit of power in it. So it's a matter of seeing really high prices for a while. And the other thing I think is noteworthy about this example, and Guillermo and Real will talk about this, but I want to highlight it now while we're looking at this figure, is notice how in interval 650, it's discharging at a price of 93. And then it's 655, it's not discharging at a price of 236. So obviously something changed in the look ahead between 650 and 655. And then you'll see at 7 o'clock, now it's discharging at 179. So something must have changed again. So there's a couple of flip-flops in the the forward optimization. And I think also, if you think about this, just going back in the discussion we had, this is an example of economic efficiency. You know, if we'd known this is going to way it was going to be, seeing these prices, it would have been economically efficient to produce the output at 236 and not produce it later on at 76. And that would have, been welfare maximizing for society and reduced consumer costs. So I just wanted to make those points on this slide. Sorry to interrupt, but go ahead.
No, those were great additions, Scott. And one other thing I'd want to add as well, a lot of times we'll see kind of out-of-merit dispatch resulting from ancillary service obligations, receipt of charge obligations, and there just aren't any of those here.
Hey, Brian and Scott, this is Cody. If I can just add one quick thing too that's not written on the slide, but the question of, is this the way that you want the policy and the algorithm to work? If this was a thermal asset like a gas plant, the math would never have you reducing your output for a higher price for a thermal asset, right? It would go as high as it reasonably can. And so this type of an event, would not be an adverse outcome for a gas plant or a hydro plant. This is something specific to the nature of batteries where these poor economic outcomes happen in the real-time market.
Well, I'd like to disagree with that. This is Scott. I disagree with that because the analogy for a gas plant would be if the MIO saw a bunch of really low prices coming up and the unit couldn't ramp down fast enough, it would start ramping it down in advance. And that's where the MIO can hurt a gas plant or any kind of plant if it sees, advisory prices that are not right. And it can also start ramping unit up out of merit and causing it to generate output when it's losing money because it sees high prices in the future and it needs to ramp it up. So, I mean, these are issues for gas plants as well.
Okay, I appreciate that perspective. I think our gas plant guys looked at this and thought this would usually be something that goes to the benefit of a gas plant. But I appreciate your extra color there. That's very helpful.
And just to add to that point, yeah, that is helpful. I guess the reason that storage is probably more affected, right, because the gas plants aren't going to have duration constraints, as you mentioned, looking at the plant energy. That's something that's going to make it kind of uniquely painful to storage. But a good point on ramping. I'm sorry, I'm mindful of the time. I know we're running a bit long. We can just run through another quick example. So we can go to the next slide, please. So this is another example, same day, same time frame, same general, adverse outcome. So you'll see this is a slightly different case. This is a second battery, and it actually did run empty in hour ending 7. So you can see it like 6:35, we're down to around 1 megawatt hour. We've exhausted the energy in the battery. But then again, if you look at the end of that hour, 6:50, 6:55, being charged up at some of the extremely high prices, right? And then, as Scott pointed out, something in the advisory price forecast changes, and you're now selling into lower prices that follow. It's kind of the opposite, the economic outcome you wanted. You're buying high and you're selling low. And just adding to the point we're saying this introduces operational risk for us, where say we've got, our charge price that we're willing to charge at is less than half of that, well under half of that $244 per megawatt hour number. The way that MIO math works, it might say, I'm going to try to charge you here at $240 per megawatt hour because I think there's a, $500 per megawatt hour price spike ahead. And the violation of your bid curve in this first interval at the very expensive charge will be more than made up by the surplus in the second interval. But, if we're submitting bids, we're submitting them to represent our marginal and opportunity costs, and trying to arbitrage a spread between, say, $50 and $150 per megawatt hour is a very different risk profile than trying to arbitrage something between $244 per megawatt hour and $344 per megawatt hour for like a similar spread but at much higher prices. So that's kind of what we mean as well when we're saying that MIO introduces risk, because it's chasing these arbitrage opportunities that are outside our bid curve that we'd really prefer not to have. And, just thinking about this outcome in general too, I mean, we're talking about, does MIO help or hurt? And if it was the case that we were seeing good outcomes where, okay, let's say MIO charged us from maybe 635 to 640, and then discharged us into these, the 655 price spike, we wouldn't be here. We wouldn't be spending so much time digging through the data to bring up these examples. We'd be grateful for it. But it's just not the case when the highest price spikes appear on the days that really matter. Were there any other questions about these examples? And again, appreciate the Kaiser folks digging into them. I think in their presentation, we're going to get to see their side of things as well.
I do see a couple of callers.
Sorry, Shreya?
Yes, I do see a couple of callers in the queue.
Okay, let's go ahead and take them.
Okay, sure. Moving on to the first caller. Caller, please go ahead. Your line is unmuted.
Hey guys, this is Mike Castellano again. I have a clarifying question here for LS Power, and if this is not something you want to talk about publicly, that's fine. I'm noticing that both of these examples are at the sort of bridge of the hour, right? The very end of 1 hour leading into the next. So one of the things that's probably happening is, there are going to be differences in the optimization solutions and sort of, if there are other resources that are scheduled day ahead that are coming on at hour end 8, that could make a difference in some things. But are the bids consistent across these 2 hours?
Yeah, so that's a great question. And actually, in some of the previous examples that we talked about with KAISO, that was what was driving some of the weird dispatch. In this case, I'll double check, but we documented this and sent this over to the KAISO folks earlier. And I believe for both batteries, the bid curves were the same in both. So this seems like just a very clear-cut case of the advisory price forecast changing. And to reiterate what Drew Gray from EDF said earlier and what others have mentioned is that, right, MIO doesn't have any memory of what it tried to do in the previous market runs. So it's just locking in these financial losses as the forecast is changing.
Mike, you are correct, though. And I think even larger than end of hour type events, we see that there are more events around the kind of change of the day, too. Hour ending 24 and 1 tends to have a disproportionate number of events. So there are corner cases around the stuff you're describing.
Okay, because I wonder what else could be going on with just because what we see here, I guess it's not that pronounced, but there's the RTM price is $100, $120 higher at interval 655 than it is at any other point in that hour, and then it is higher. It does seem like there's something real going on there because it stays higher for a couple intervals. But I wonder if there's some kind of either exports ramping up or some kind of other change going on across that in that switch between hours that could be part of why it's so pronounced here.
I remember the optimization should have seen that at 635 and 640 and 645. Anything that was going on, even if the bid curve was changing, we should see that when we were looking ahead. So there are real changes that happen at the top of the hour, as you said, like exports and so that can cause real price changes. But then when Guillermo and Real are going to get up here and show you, what was going on in the advisory intervals, which is different from this. So the advisory intervals, we're seeing something different. And, that's what we're going to switch to talking to in a couple of minutes.
All right. Thanks, guys.
Okay, moving on to the next caller. Caller, please go ahead. Your line is unmuted.
Hello, this is Perry Servideo, GDS Associates. I just had another kind of quick clarifying question for this example. It looks to me, you have a battery here that is near empty going into the top of the hour. And there is going to be an opportunity to discharge later at a high price, so you need to get some gas in the tank. The optimization chose to charge you up at the end of the hour so that you have some gas in the tank to discharge later. It was out of merit. So my question to you is if you've investigated the BCR revenues associated with these 2 5-minute intervals here. Theoretically, it should make you whole to these losses if by the end of the day you were not already made whole of the losses with the economic dispatch.
Yeah, Perry. So this is something that also is a big problem for us. So we've never seen big cost recovery for any of these out of merit MIO dispatches. So this day, all the other days, the BCR column, in our settlements total it's $0.
So that seems to tell me that you were profitable by at least this much throughout the rest of the day. So there were no losses.
I mean, Perry, the point is that the profits they should have earned are used to subsidize the uneconomic dispatch.
Sure. Yeah.
That they should have.
Yeah,
so
I agree. This looks like a top of hour problem here. Just curious if people are calling for changes to BCR, et cetera, and I just wanted to see if there was an issue with BCR here or if those revenues are included.
Okay. Thanks, Barry. Trio?
Okay, moving on to the next caller. Just wanted to remind you to please mute your phones. I can hear my voice in the background. Thank you. Caller, your line is unmuted. Please go ahead. Caller, please go ahead. Your line is unmuted. I have unmuted the line from my end. Please unmute from your end and proceed with your question.
Hi. Thank you. This is Alan Meck from SDG&E. I have a question about this data. Starting at 7 o'clock, it looks like you're being dispatched for a positive amount of energy, but the plant's total energy in megawatt hours in the column on the right is not changing, it looks like. What's going on there? Like, this battery is almost out of juice, I thought, but it's being dispatched over and over again, and it doesn't seem like it's affecting the megawatt hours.
So this is looking at 4, 5, and 4 starting at 7 p.m. 7 a.m.
Yeah, I mean, part of that is 5 minutes versus an hour, but the quantity is going up, even though the dispatch is positive.
Right.
So I'd actually left off the imbalance charging that we were getting from Reg down there, just because wanted to focus on the real-time dispatch. But that's why there's a discrepancy between the real-time dispatch and then the actual energy going in and out of the plant. That's a good question.
Okay, that makes some sense.
This is Jim. I just wanted to point out that it looks like there's something curious happening at 7:30 and 7:35, I think on the previous slide as well. And what's interesting about that is there isn't really much going on with the real-time price, where the real-time price does spike between 650, 655 and drop again. So there's a lot clearly really going on that the advisory interval maybe didn't anticipate in advance, but there's something going on where at 7:30, 7:35, and I think it was more pronounced on the previous slide, that there's a change to how the battery's operated. It's more modest here, even though the conditions seem to be quite stable around it. So maybe we'll hear more about that too.
Okay, thanks, Jim. Let's see. A member of the ISO staff, Fan Zhang, had a question. Fan, you want to ask your question?
Yes, but it's on mute.
We can hear you.
We can hear you.
Oh, okay. So I just want to put a comment on the battery one. If we can go back to the previous slide. Okay, so here, like LS is a concentrate on the 655 with high LNP, and then its discharge is 0 with 108 megawatt hour left. That's in the third column. But the reason we have 108 left probably is because MIO in the previous interval such that we still have 108 left. Otherwise, you will be discharged before you get into this. And then when you see the 236, then we don't need to discuss anything. The megawatt hour is already 0. That's just my comment.
Fan, this is Cody. Just I think if you'll do the math on the previous intervals, you'll find that the plant energy would have been a bit lower than 108, but not that much lower. So maybe it would have been 100 or high 90s.
Yeah.
It would not have been empty, but
I don't know exactly what's the bid. And let's say if your bid price is $90, and then you will be discharged more when the LNP is higher than 90 if without MIO. So that will bring your the megawatt hour left much lower than 108 when you get to 655. Just comment.
Hey, thank you for that. And in this case, we've looked back and we've sent the full time series of all the charge and dispatch data to KAISO, and that's just not the case here. But you're right, it's one of those things where we are looking, is MIO leaving us better or worse off? And if it was leaving us better off, I'd love to be doing, other fun modeling stuff, but just not the case here.
Okay, thanks. Let's see. I would like to get to the ISO's presentation since we're at 10:30. Is there another question, Shiv? And if so, let's make it very short.
I do not see any further questions in the queue as of now.
Okay, thank you. Thank you, Brian and Cody. I think you still have a couple more slides, some other points you want to make, right? You have some recommendations.
I think we can cover them. I think the point of today was mostly to diagnose the problem, can talk about them very briefly. One was just asking for more transparency on the performance of MIO and advisory prices. So I think that's a lot of the point of today, and we really appreciate the KAISO folks putting in the legwork to do more of that. Another would be in the interim, BCR of some sort, just to compensate resources for being dispatched out of merit. And then potentially, as we've talked about, evaluating if MIO should not be applied to storage, or if resource owners should be allowed to opt out of MIO for storage resources.
Yep. Yeah, we can skip our last slides. I think we've covered all of the major points. And as Brian said, we've recommended that it would be great to be able to opt out since we see MIO having negative effects overall on our ability to dispatch the resources. Even if that is not possible for whatever reason, I think there are other approaches, adjusting the way that MIO is implemented specifically for storage. we're not heavily prescriptive on what the fix would be. I think we want to work, closely with CAISO to, set the incentives right that make it possible to operate these resources and to, bring on more of them.
Okay, thank you. I'm sure we'll get much more opportunity to talk about this, especially some of your recommendations, if not today, but at the future sessions. So at this point, I'd like to welcome Guillermo and Rahul, who have a presentation about the ISO's analysis of these issues. And I think Guillermo will be going first.
Yes, Ben, thank you for the introduction. Can you hear me okay?
Perfect.
Yes.
Okay. Thank you to the MST for the opportunity to discuss this morning the topic of multi-interval optimization. This is a timely topic that has attracted a lot of attention. As we continue to see the rapid penetration of storage resources in the CAISO system, it's a critical item to discuss given the type of conditions that we have to identify to pave the way to identify mainly the drivers and potential solutions for this. We understand the concern expressed by participants and LS Power in this presentation. And for this presentation, I would like to step back a little bit and try to start with a broader context. Having specific scenarios is helpful to boil down specific cases of what happened. And we have that for the second part of the presentation. For the first part, I would like to bring the discussion in a more general context because there is more beyond these specific scenarios. We are receptive to all the concerns expressed about the multi-interval optimization, and we are open to continue assessing the drivers of these outcomes that can inform the stakeholder process that is led by GAIF so that we can further discuss about potential enhancements. With that, let me start the presentation. Next slide, please. Let me give you just some picture of how things are working out for storage. And you can see that 2021 has been very active. We have seen a significant penetration of storage resources. These trends for the last 6 months show a steep addition of state-of-the-charge capacity to the CAISO system. In a matter of 6 months, the state of charge went from less than 1,000 megawatt-hours to over 5,500 megawatt-hours. We can see the general trend of the state of charge reaching its maximum levels in the hours prior to the gross and the net load peak, which is the time when supply is the most needed. And then resources can be discharged through the peak and through the rest of the day. Next slide, please. Another interesting trend is that given the early life of the storage resources, we can see that participation of these resources in the market is evolving, not just by having more capacity available, but how that capacity is bidding through the markets. We can see in this, for instance, the day-ahead trend, and how actually the trend changed between the day-ahead and the real-time markets, and how in a matter of months, the economic participation is shifting. Obviously, this is closely associated with the current and expected system conditions. And this is a representation of just 2 months of the summer conditions. Next slide, please. This is real time. The point here is to consider that economic participation of storage resources is going to be one of the drivers of how the market considers to dispatch those resources. Economics, at the end, is a factor in the optimization. If you are interested to see more how the storage resources are participating, we have put more analysis in the monthly summer reports that are publicly available. Next slide, please. Now, let's start with the basics to give the context to the discussion. We have day-ahead, real-time markets. The principles are basically the same. The conditions are inherently different. The real-time market is composed of 15 and 5-minute sub-markets. The 5-minute market is the one that produces the dispatches that are sent to resources, and they have to be followed. These are the DOTs, the dispatch operating targets, issued through our ADS system to all resources. The RTD market runs every 5 minutes, with interval granularity of 5 minutes. The 5-minute market, we have one binding interval, that is the one that produces both dispatches and prices that are binding, meaning these are the market results utilized for issuing instructions to follow and prices to financially settle resources. Like any other market, the objective is to balance supply and demand, and this is on a 5-minute basis based on the least cost dispatch, while we comply with all the resource and system constraints. How do we achieve this? Next slide, please. Internal to the market, we have an optimization problem, and that is formulated with an objective and a set of constraints. This is a very simple illustration where the objective of the mathematical formulation is to minimize the total cost, and that is over multiple intervals. That is the cost of the summation of the interval 1 plus interval 2, and so on. That's the reason we call this multi-interval optimization. The cost of each interval is equally important from the point of view of the optimization. The formulation doesn't give more importance or more weight to one interval, even if that is the first interval. The minimum cost will be defined as the overall summation of all the interval costs. So the market can strategically go over a higher cost in one interval if that can result in a much lower cost in a different interval, because all what matters from that point of view is the total cost as the overall summation. When it comes to constraints, different constraints will create coupling between intervals. It means the dispatch made for one interval is going to influence how the dispatch is going to be determined for the rest of the intervals. And that is even more critical for batteries. This discussion is relevant for all types of resources, not just for storage. For many years, we have this concern of conventional resources being dispatched out of merit. Some cases are very intuitive when you refer for those of temporal constraints. For instance, the market may commit a unit prior to the peak in order for the unit to be readily available to meet the peaking conditions. So the unit may be running out of merit at the beginning for the sake of maximizing the production at the peak times. And in some cases, the optimal solution may indeed require an uneconomical commitment of a unit. This is one of the well-known implications of a cost minimization formulation. That is one of the main reasons, basically, every ISO market has some type of bid cost recovery mechanism. Next slide, please. The real-time market utilizes this multi-interval optimization. That is the core framework of our market. Here, horizon is defined as the period of the time used in the optimization and is composed by multiple 5-minute intervals. Our real-time market uses a horizon of up to 13 intervals. The first interval is always what we call the binding interval, while any subsequent interval is advisory, because they will be reassessed in subsequent RTD market runs. This brings the basic question of why do we use multi-interval optimization? The idea is very simple, and is to use a horizon that is long enough to foresee current and projected conditions, because conditions will change, and typically they will change at the top of the hour, like intertie schedules or unit commitments as was discussed earlier today. The main reason of having this multi-interval optimization is to allow the market to see conditions evolving in the near future, and most importantly, to position resources accordingly to better handle the changing conditions. Coming back to earlier comments, we are not guessing what the future is going to be. Rather, we are simply taking the most updated information of the conditions that we know by the time the market has to run. Granted, 40 minutes later, things may change, and we again consume that most updated information. This is not just to position conventional resources, but to be able to better dispatch all types of resources, including the storage resources, given the fact that conditions in the real time are inherently dynamic. This has a lot of intuition. For instance, if for 30 minutes now we are projecting a cloud cover coming in, and that is going to knock down, let's say, 3,000 megawatts of solar production. Don't we want to start dispatching resources and ramping them accordingly to be able to offset that change? Well, the multi-interval optimization gives you precisely that. If we don't have multi-interval optimization, and let's say we use only one interval or two interval optimization, the market will be catching up in every single interval, trying to realize just 5 minutes before what needs to happen. And in this case, in this illustration, if we're going to be 3,000 megawatts down 5 minutes before it happens, that is not a very good, reliable way to operate the system. Here is the reality. The real-time market is inherently dynamic. Load changes, intertie changes, VR production is going to change, transmission conditions are going to evolve, congestion is going to change. These are conditions bounded to happen. Multi-interval optimization gives us the opportunity to position resources for that. Whether that will be perfect or not is obviously for discussion, and obviously it's not going to be perfect. Precisely because conditions change, in some cases, even multi-interval optimization will not be able to capture this. Will the lack of the multi-interval optimization better handle the changing conditions? That's to be seen. So when we look at the multi-interval optimization, it's important to look at both sides. Not only the downside when there are economic dispatches or out of many dispatches, but also the benefits provided and the cases where the dispatches may not be expected. There was some discussion earlier today that they may or may not perform at critical times when prices are volatile. Well, there is a lot of logic for that, because when prices are volatile, it's precisely because there are system conditions changing and volatile as well. And precisely under these volatile conditions, things will move quickly from one interval to the next. So it's not a matter of the multi-interval optimization. It's about the inherent changing conditions in the system. Next slide, please. Coming back to storage resources, like other resources, we model those resources with the classical definitions, the resource characteristics. We have resources that can operate in a positive and negative range, charge, discharge. They have upper and minimum limits that we have to respect. And they can participate in the energy and the ancillary service market. And one thing that makes them quite unique is the nature of constraints they may have. Next slide, please. Similar to other resources, in addition to classical constraints, we have these attributes of the formulation for the storage resources, and that is effectively the state of charge. It's a limited resource that we have to maximize the energy that can provide in a given limited period of time. And that is going to only add to the complexity of finding the optimal solution when you take into account not only the classical constraints of the resource, but also these unique constraints in the system. How you dispatch the resource right now is going to have further implications down in subsequent intervals. Next slide, please. And this is just to illustrate that precise concept. Coming back to the multi-interval optimization, this is a very simplified formulation to showcase the multi-interval optimization. We continue to have the minimization of the overall cost across the whole horizon. That is the nature of the multi-interval. We have the resource constraints that, in addition to comply with the typical resource limitations, such as the Pmin, the Pmax, procuring AES within the limit, we also have the minimum and maximum state of charge constraints. In this case, the subindex T relates to the intervals, as you can see, and there is coupling across the constraints, across the intervals, related to the state of charge constraints. And obviously, we have other constraints, such as the ramp limits. Basically, the state of charge for the next interval will be based on what the state of charge for the current interval is. Thus, optimizing the dispatch for storage resources for one binding interval will be strongly dependent on how the system is positioning the resource across the entire horizon. If the market is projecting a condition, let's say 40 minutes from now, such that it needs additional supply, The implication may be that the storage resource needs to charge in the first intervals, even when it may be out of merit for some intervals, because it is projected to be offset for bigger revenues in subsequent intervals. Next slide, please. Now, bringing this back to the discussion of the scenarios that we have discussed for some time with participants about the economics, the dispatches out of economic merit. This is a bigger perspective I would like to emphasize. When looking at only the binding interval, a dispatch may be out of merit. And we all acknowledge that this has material financial implications because we settle only on the binding intervals. This outcome, however, is based on the optimal dispatch across the entire horizon, and we all understand that implication. And the drivers are more than just economics. The root of all this is basically the changing conditions being projected in the near future, and the fact that the optimization takes all that into account, even the resource characteristics. Based on analysis that we have been doing, we have here illustrated a short list. By no means this is exhaustive, but some of the drivers for having dispatches out of merit is beyond economics. It's where we really put the pieces together, because naturally storage resources are unique, but also they have unique constraints that we have to take into account. Multi-interval optimization allows us to project for these conditions and ensure that the resources are dispatched along the intervals to be able to comply with all these constraints, including the state of charge. If we don't have multi-interval optimization, we would be realizing 5 minutes before the condition happened, for instance, that we would be violating a maximum state of charge constraint, because starting in the hour, now there is a different limit on the state of charge constraint that we never had the opportunity to project and be able to move the resource in that sense. Now we may be hearing from participants that you are not respecting my maximum state of charge. Is that a better outcome? Or that we have to disqualify ancillary services because we don't have enough use to be able to procure all the AES capacity that was procured because there is no sufficient state of charge. The multi-interval optimization allows us to see that that is coming and position the resource to be able to honor that AES, that otherwise if we use just one interval at a time, most likely we will have to disqualify that ancillary service. Is that a better outcome? There are very material implications to consider when having or not having multi-interval optimization. And I think we know the cases where we have dispatches out of merit because we have been discussing those. I think we should also pay attention to the ones that are being benefiting because we have multi-interval optimization. Through previous stakeholder discussions, we have gone through a series of cases why the resources are dispatched out of merit, and we have analyzed every single one of those. At this point, we have seen that the multi-interval optimization, the logic, the formulation is working as intended. The drivers, the root causes as to why the multi-interval optimization is producing these dispatches is the piece that is going to be very interesting to discuss in the subsequent section. And this is the first part. The second part is really about what really happened on specific scenarios. Now, before going into the specific scenarios, I would like to keep it at a very high level. The natural question is going to be how frequently this is an issue in terms of having dispatches out of merit. Can we move to the next slide, please? We have done some analysis. We have looked at the last year, the last few months, to try to estimate, based on the binding information, based on the bids and prices and awards, how frequently storage resources have been dispatched out of merit. And this is a very simple trend showing in blue, the frequency of intervals being dispatched in merit versus the one in orange or red for intervals being dispatched out of merit. Yes, there is a consistent trend where we have it basically in every month resources being out of merit. The frequency varies according to the month. There may seem to be a higher frequency during the shoulder months and also in the peak time of the year. We went one level deeper, and can we move to the next slide, please? And track by individual resource, the same frequency. And this is, and I want to relate this to a previous comment that was done earlier today, that yes, at the system level, we can see there are always cases of these conditions. When you look at the individual resources, it's not that extreme, meaning it's not all one-sided. You can see that there are resources that, yes, consistently they are dispatched out of merit to some level of frequency, like the ones at the bottom. But you can see there are other resources that basically have no instances of being dispatched out of merit. And that varies by month, by resource, and here you have basically the whole sample of resources. And we have to recognize that the frequency of that condition is based on all the conditions, right? And we have specific system conditions, economics, how participation of these resources is going to play a factor, how they are dispatched. Location is going to be also a factor because in some cases, as we are going to illustrate later today, congestion is the driver, and that means where you are located matters. I would like to keep this as a perspective of how pervasive, how systemic is the issue that we're discussing here. And I think that's all what I have for the first part. The second part is really focused on very specific scenarios and trying to answer some of the questions that were posed in the earlier discussion today. So I will be happy to take on any questions before we move to the scenarios.
Okay, Guillermo, this is Scott Harvey. I just have an observation about this, that to clarify comment, when you're saying out of merit, it just means it was out of merit in the interval. It doesn't mean it was actually necessarily uneconomic. It might have actually been an economic MIO dispatch, but this is just saying that in the binding interval it was not economic. We haven't really studied how many of these made money or lost money over the optimization horizon.
Correct.
As a reminder, if you're connected to the computer audio or use the call-in feature in WebEx, you may enter the question queue by using the WebEx raise hand icon located just above the chat panel. You'll hear a beep tone when your line is unmuted. At that time, please state your name and question. If you're just on the phone line and not using the WebEx audio, please dial #2 on your phone to enter the question queue. You'll hear a notification when your line is unmuted. At that time, please state your name and question. I do see one caller in the queue. Caller, please go ahead. Your line is unmuted.
Hi, Guillermo. This is Alva from PG&E. Just one question on these two slides. I think these are really interesting. These are the frequency of all market resources, or did you segregate NGR from other market resources? And is there what's the difference between out of market or out of merit dispatches on SOC managed NGR versus any other type of resource in the system?
This is specific to storage resources. It's only storage resources that are shown here. And I believe it has all the storage resources that we have so far, but maybe one missing, and that may be just because of space.
Would you say the frequency of out of merit dispatches is much, much less frequent on any other type of resource?
I don't have a metric to give you a specific answer on that, and I would have to look at the overall spectrum of resources to see how different storage resources is relative to others. I just don't have a number right now in front of me.
Great. I mean, that might be one angle on how specific this problem is to NGR. It's a great, great way of presenting the data, though. Thank you.
Yeah, thank you. That's a good point.
I do not see any further callers in the queue as of now.
Hi, Guillermo. This is Cody. Can I ask a quick question?
I'm sorry. Is that Cody?
Yeah.
Yeah. Go ahead.
Yeah. Thanks. I second that. This is a really great way to visualize this information. I think we absolutely agree that the vast majority of intervals, the dispatch is in merit as shown here. The question that we're interested to know, have you looked into this and maybe we can follow up on, have you looked at specifically just on, the extreme days, the heat wave days, the flex alerts and those types of things? Because in our experience, those are the ones where it really matters and we think that there's more of this happening than on an average day.
Yeah, that's a good point, Cody. I think there are so many ways we can slice and dice the data, and we are open to continue analyzing in different ways. So I take that point for a future way to present the information.
Thanks. That was my question.
Thanks, Cody. Okay, if that's it for questions at this point. We can continue on, Guillermo.
Okay, I will pass it to Rahul to go through these scenarios now.
Okay, welcome.
Hello, everyone. This is Rahul. I can confirm you can hear me.
Yes, I can hear you. Please go ahead.
Thank you. So first, let me thank Corey and Brian. LS Power has been really patient with the ISO and working with the ISO, providing several instances and scenarios that has really helped us look much deeper into how we can improve our existing storage modeling. And we have really been working with LS and few other participants looking into the specific cases and trying to understand, what are the current deficiencies and where are the room for improvement. So I want to just focus on this chart first before I, go into scenarios. So when we got this request to analyze the impact of multi-interval optimization, we wanted to take a step back and see, what exactly is the main problem and what scenarios are maybe causing some participants unlikely outcomes. And so what we did is first we tried to quantify the frequency of this problem. And, the frequency is one metric and it's pretty crude, but it gives you a good indication of, which intervals we are seeing or how many intervals we are seeing uneconomic or out of merit dispatch. And, as we discussed so far, out of merit dispatch does not necessarily give an indication that something is wrong, but out of merit dispatch gives us a good indication for us to look much deeper into, what is driving those dispatch. So, when we started working on this presentation, we wanted to give a good background about, how did we get here and why are we today in this multi-interval optimization world? Because, when we implemented our software for the nodal market, we had the need to always look for the future horizon and make sure the system is set up for any changes that are coming in the horizon. And when we implemented the NGR model, we had to make sure that, the NGR model is consistent with our basic principle of look ahead. So that's why we added some of the basic equations of NGR. And those equations are added to this presentation to show the link between different markets, different time intervals. So what we have done in future scenarios is to show that, out of merit dispatch can occur for different reasons. So let me go right into the first scenario. Can we go to the next slide? Okay. We can move on to one more. Okay. So this is a specific example in which a resource is being dispatched out of money. And it's not being dispatched out of money because of the future horizon, it's because of its ancillary service. In this case, this is a storage resource whose upper economic limit is 9.87 megawatt, and its regulation is 19.07. So this, should immediately strike you that the regulation of award is much more than its discharge range. So when the regulation award is much more than discharge range, naturally, in order to make sure that the resource can provide 19.07 megawatts of regulation, it has to be discharged it has to receive an energy award where it is forced to discharge. It has a bid to discharge at 28.97, what basically means that it does not want to pay more than $28.97 per megawatt hour for energy. However, the LMP is 33.78. So in this case, it really doesn't make sense for us to dispatch if we were just looking at the energy award. However, in order to support the regulation of award, we are forced to discharge. We are forced to charge this resource at 9.2. Thus, this resource appears to be dispatched out of merit, and this is not a bad outcome from a market perspective because the resource is already being paid for regulation up, and once it's forced to discharge, once it's forced to charge in the 5-minute market, that is to ensure that it can support its regulation up award. Can we go to the next slide? Okay. This is the same information in the pictorial format that can help you understand what exactly we are talking about. And as you can see, the resource has both charge and discharge range. The charging range is shown by the brown color. The discharge is shown by the gray. And you can clearly see that in order to support its regulation award, it has to be forced to charge. And that's the main reason the resource is being, receives an energy award out of money. Can we go to the next slide? Okay. So this is what I wanted to focus on is if we were to have a rule in the market which says that the resource has to be we only consider its energy bid and no other constraints, what would happen? In this case, the resource already received the regulation of award. If we do not end up, force this resource to charge, then we would have to take back its regulation award, and the resource regulation award would be reduced. And that's definitely not a good outcome for the resource and for the reliability purpose because our systems were already relying for the regulation up from this resource. So, you can see that the energy award itself is not purely driven just by its energy bid. It's taking into account its ancillary service, and when you take into account the ancillary service, this award makes sense. And just keep that in mind that, those out-of-merit dispatches that you see in the slide that, Guillermo ended with, some of those out-of-merit dispatches are because the resource had an ancillary service award. And I'm just showing you an example for regulation up. A similar scenario could be a resource has spin award or a resource has regulation down award. All of those scenarios can result in out-of-merit dispatch. Let's move to the next example. So this example is explaining a scenario where the 5-minute dispatch in the binding interval is impacted by the self-schedules that would show up in the future horizon. So when you are looking at this slide, you can see we are talking about a real-time dispatch which has a 13-interval dispatch horizon. The first, from 6:20 to 7, the market is using one set of bids. From 7 to 7:25, the market is going to use the different type of bids because in the ISO market, participants can submit hourly bids. the key thing to focus in this example is, the resource has a self-schedule to discharge 9.85 megawatts for the entire hour. That's from 7 to 8 o'clock. The resource initial state of charge is only 1.77 megawatt hours. And the maximum SOC for this resource is also 9.85. Now, if you look at the time frame from 6:20 to 7, the resource has a bid to charge, and it's willing to pay no more than $3.14. And the minimum SOC for the resource is 1 megawatt hour. So, as you can see from the example, if market has to ensure that the resource has enough state of charge to honor its schedule in between 7 to 7:25, we have to take some action in the binding interval. So can we go to the next slide? So here we see, what's actually happening in the 13 interval real-time dispatch horizon. The market is being forced to charge this resource continuously from interval 1 through interval 8. And it's doing that because in the future horizon, that's from interval 9 through 13, it has to discharge 9.85 megawatts. Now, the challenging aspect for the market in this case is you can see the blue dots show the state of charge, and the green bars show the dispatch. The bid is only 3.12, but the LMP is 24. So essentially, market in the binding interval is going to dispatch this resource out of merit. And it's doing this, dispatch out of merit to ensure that in the future interval, in the future horizon, we are able to honor the self-schedule to discharge. Can we go to the next slide? Okay, so, we just ran a counterfactual scenario in this case where let's say there is no multi-interval optimization. And we have currently our market does not support this feature. So this is a very hypothetical scenario that we created where we said that, okay, if we do not charge the resource out of money, then what's going to happen? What's going to happen is if the resource has submitted a self-schedule for the next hour starting at 7 o'clock, and if we do not force charge it in hour ending 7, then in hour ending 8, it will not be able to discharge. And if it's not able to discharge, that's the exposure the resource is going to take if it doesn't take part in the multi-interval optimization. Okay. Can we go to the next slide? So I'll cover this scenario and maybe then pause for questions. This scenario is, very similar. What we are trying to show is, what's happening in the future interval impacts the dispatch in the binding interval. This again is a 13 interval RTD horizon where the start time is 11:15 p.m. and then the end time for the real-time dispatch is 20 minutes past the top of the hour. The resource has a constraint that's maximum state of charge of 180 megawatts hour. And in the previous hour, the initial state of charge is 208. So then, we obviously have a condition where if we are looking up in the future horizon, we have to make sure that we're going to honor the maximum SOC. Otherwise, that could have significant implication on the resource itself if we do not honor the max SOC. Can we go to the next slide? Okay. So, here clearly you can see in the first interval, the resource offer to discharge is $250. However, the LMP is only 24. And because, there is no, if we were just to dispatch the resource purely based on the energy bid, we would not honor its maximum state of charge in the next hour. And that's why the resource is being forced to discharge out of merit. And as you can see, the future interval prices are all around 20, somewhere between $30 and $20. So even if the intent is to push the discharge in the future horizon, let's say we were to discharge them say 7, 8, or 9 intervals, you would still be dispatched out of merit, and you're not being dispatched out of merit purely based on your energy bid. Just using energy bid is not going to solve this kind of problem. You are still going to be dispatched out of merit. And this is one of the examples that would fall in the bucket of out of merit that we initially classified. Can we go to the next slide? Okay, so I think the scenario 4A, B, and C are some of the scenarios that we already have seen from LS Power. And what I'm going to do here is to go into the reason why, what is happening in the market that's driving the change, and what change is causing the difference between the binding and advisory interval dispatch and pricing. Before I do that, I just want to see, in interest of time, do we want to take questions or do we continue with these examples?
As a reminder, if you're connected to the computer audio or use the Call Me feature in WebEx, you may enter the question queue by using the WebEx raise hand icon located just above the chat panel. You will hear a beep tone when your line is unmuted. At that time, please state your name and question. If you're just on the phone line and not using the WebEx audio, please dial #2 on your phone to enter the question queue. You'll hear a notification when your line is unmuted. At that time, please state your name and question.
Okay, sounds like we have no questions.
Okay, thank you. Let me move on. So, starting with this scenario 4A, we are going to look at certain resource dispatch and awards, which are purely based on resource bid and what's happening in the future horizon. There is no interaction of ancillary services, no interaction of self-schedule or change in bid across the hour, or there is no interaction of change in any of the minimum or maximum SOC constraint. So let me set the stage for this example. What we are looking here is we have the 12 interval real-time dispatch, which starts with 1250 and ends at 1350. And in this case, we have the resource which has a discharge offer of 120 for 150 megawatts, and it has a bid to charge 100 megawatts at $60. So, as I mentioned, there is no other constraint that would impact this resource dispatch in both binding and advisory intervals, other than all the other market inputs. And we will see that, things in the future horizon is mainly driving what's happening in the binding interval. So can we go to the next slide? Okay, so this is one of the examples that we have, discussed before in the LS presentation, where you can see in the binding interval, which is shown by the x-axis, which is interval 1, the offer to discharge is 250. The LMP is only 36. Now, this discharge clearly looks out of merit. So why is the market doing that? When you look at the future horizon, specifically if you look at price from interval 6 through interval 12, for this time horizon, the price is negative for the resource. So the market finds an opportunity to charge the resource at the negative price. And in order to charge the resource at the negative price, the market is discharging the resource in interval 1 and 2 out of merit. And as we'll see in next slides, that there is a specific reason that the market is dispatching the resource the way it is. But the key thing to note here is, interval 1 is the binding interval. Interval 2 through interval 12 are the advisory intervals. What everyone can see on Oasis is the binding interval price of $36. Currently, the ISO does not publish the prices for the advisory intervals. That's for intervals 2 through 12. Can we go to the next slide? Okay, so this slide is showing the net revenue for the resource across the horizon. And you can see that the binding interval, the resource has a loss of around $1,000. But when you look at the advisory interval revenue, it has a total profit of $1,200 approximately. And based on the market horizon, the resource is in fact making money of $193. So that revenue makes sense when you look at the RTD dispatch for a single horizon. And as I said before, interval 1 is binding, intervals 2 through 12 are the advisory interval dispatches. And then what's happening from intervals 6 to 12 is where the resource ends up making money, and not in the first 5 intervals. Okay, can we go to the next slide? So now the natural question is, what did we project and what actually happened? The LMP that's shown in black is the LMP that was seen by the RTD dispatch that started at 1250. And the dispatch in green is what was projected from that market run. However, what actually happened in future intervals is the negative price that was projected from intervals 4 through 12 really does not materialize in the same shape as what was projected in the original RTD run. And the LMP, instead of being negative from intervals 14.2 to 14.6, is now positive. So, this naturally is going to fall into the scenario where what was projected by the 5-minute market in one case does not materialize in the subsequent case. So we have to, look at two things. What actually changed, and once, things change, did the change make sense based on that specific case? And then if you take a step back, see, is it the multi-interval optimization that's causing this issue, or is this something else? So can we go to the next slide? So, when we analyze this case, we found that the resource is uneconomically discharged in hour ending 13 interval 11 and 12 because it was seeing a projected lower price. Now, the lower price that was projected in the future intervals was mainly related to congestion on this doublet tap fryers constraint. This is a transmission constraint in San Diego area. And in one of the RTD intervals, which was projecting lower price, there was significant congestion on this constraint that was driving the price negative. However, as we rolled through subsequent 5-minute intervals, the shadow price on this constraint changed. And the shadow price on the constraint is changing because we are seeing the change in the output of a set of solar resources in the San Diego area. So as you can see, it's not necessarily the multi-interval optimization setup that's driving the difference in price. It's actually the change in system conditions that the real-time market sees. And as we roll through the different window, you are going to see that different inputs going into the market will have an impact on the pricing. And the multi-interval optimization is doing what's supposed to do. It looks at the horizon and it dispatches resources. Now, if the inputs going into the market optimization changes, you are going to see different market results. Let me cover one more scenario, and I think then we can pause to see if there are questions. Okay, can we go to the next slide? Okay, so in the previous example, that was scenario 4A, we were looking at a case where a resource was discharged uneconomically. Now we will look at a scenario where the price looks very attractive, but the resource does not receive an award. And what is driving that in those cases? So now we are looking at a real-time market which had a start time of 6:55 and an end time of 7:50. In this case, the resource initial state of charge is 111, and the resource discharge offers, it's willing to discharge 132 for $75, and you can see the subsequent segments. One thing to note, what's specific about this case is we had congestion on two transmission constraints. The first constraint is the Midway-Vincent, that's a 500 kV line. The second constraint is the Lugo-Victorville, that's another 500 kV line. And the congestion on these constraints we are seeing in the market is for several contingencies that ISO is monitoring in real time. And those contingencies are credible contingencies that our operators have to monitor depending on the system condition, outages, and so on. So the key scenario in this case is, we see a high price, but we are not seeing the dispatch that we expect. Can we go to the next slide? Operator, can we go to the next slide?
I think I advanced it. Okay, let me advance it.
Give me 1 second. Maybe it's a delay on my side. Okay, thank you. I think maybe you give me 1 minute. I think, can we go back a couple of slides? One more. Yeah, sorry, can you go to 29, please? Okay, so this picture gives you a very good idea of what I'm talking about. Here in the first interval, the LMP is 236. The offer to discharge is 122. However, the dispatch is 0 megawatts. Now, the natural question is why we are seeing a 0 megawatt dispatch when the LMP is 236. You can see that in the advisory intervals, in intervals 2 through interval 10, the price is much higher in those intervals than what you see in the binding interval. So the first advisory interval, the price is 592 and the offer is 120 and the resource is dispatched to 210. That's the interval where the market sees the best opportunity for resource to be dispatched. And in the subsequent intervals, you can see that the dispatch is gradually lowered just because of the price in those specific intervals. And you can see, even though when you look at the initial condition and we feel that the resource has enough state of charge at the beginning, but based on the resource dispatch capability, it is completely discharged by interval 10 in this 5-minute dispatch horizon. And so essentially, you can see that, the main reason the resource did not receive an award because, first you have a limited state of charge such that, it cannot be dispatched to its full capacity for the entire hour. Second is you are seeing an LMP which is higher in the advisory interval. Okay.
Rayul, I just want to point out one thing though, and that the margin is actually, the trade-off is between interval 1 and 10, not between 1 and 2. So it's giving up 236 in the binding interval to get 238 in the interval 10 intervals out. So that's the trade-off, right?
Yeah, that's one of the aspects of what we are seeing here.
Yep.
Thank you, Scott. Okay, so let me cover a couple of other questions that we naturally are asking ourselves when we look at this. The obvious question is what's happened in the future binding intervals. So can we go to the next slide? Okay, so when we look at that example, we really want to see what's happening between two 5-minute market runs. So here what we did is we compared the market with the start time of 6:55 to 7:50 to the market with the start time of 7 to 7:50. And ideally, if the system conditions remain exactly same, then the two highlighted squares, the square which is the first advisory run from the 6:55 start time should see exactly same price as the binding interval in 7 to 7:50 because, all inputs remaining same, optimization should give you a very similar result. Can we go to the next slide? Okay. So, this was something that we discussed previously in LS slides. We see that the advisory LNP, which was around 650, is now reduced to 178. So the natural question is, why does the price drop significantly from 650 to 178 in one specific binding interval? Not only that, as you can see by the chart on the top left, the LMP-A in all the intervals is much higher than LMP-B in all the intervals. And, this is the key answer for us is the change is actually happening between these two market intervals because we have a change in the limits that is used for one of the transmission lines. Now, as I mentioned before, in this case, we have two constraints, Midway Vincent and Lugo Victorville. During this specific time frame, our operators were actively managing the flow on this specific line. And when I say actively managing flow, our operators are routinely looking at the actual flow or the state estimator flow and trying to make sure that they have enough reliability margin to ensure that the flow on that line or the flow on that line contingency pair does not exceed a specific limit. So what we saw during this time frame is, our operators have seen something on the grid and they start reducing the limit on this specific constraint. Once they reach a specific limit, they realize that, maybe that's not, they don't want to lower it to that specific limit. And then they raise the limit. So that's what's actually happening between the 650 start case, 655, and 7 o'clock is you see an impact of reduction in the limit, and then you see that once the limit is relaxed, the price changes. So essentially, what I'm trying to drive here is it's not just the multi-interval optimization that's driving the market solution. It's the inputs that go into multi-interval optimization that, changing the market solution. And as we've mentioned before, we are operating the real-time market with a lot of uncertainties. You have uncertainty in forecast. You have uncertainty for variable energy resource output. Because of these uncertainties, you also see changes in system condition that could result in a congestion pattern. And at some point, our operators may have to actively manage those constraints. And when they manage those constraints, we do see an impact of change in market solution. And some of those solutions may result in the outcome that we are observing. So let me pause here and see if there are any questions.
As a reminder, if you're connected to the computer audio or use the WebEx Call Me feature in WebEx, you may enter the question queue by using the WebEx raise hand icon located just above the chat panel. You'll hear a beep tone when your line is unmuted. At that time, please state your name and question. If you're just on the phone line and not using the WebEx audio, please dial #2 on your phone to enter the question queue. You'll hear a notification when your line is unmuted. At that time, please state your name and question. I do see one caller in the queue. Caller, your line is unmuted. Please go ahead.
Hello, Rahul. This is Alva at PG&E. Really well presented all of these scenarios, first of all, showing that there are times that you can't avoid uneconomic dispatch, and then finally showing these examples corresponding to LS Powers, where the changes in prices are causing these solutions. This is a question actually for the committee as well. Are there approaches that would discount in the objective function the prices that actually aren't ever going to get realized? And is there any evidence that you could get a more efficient solution with that approach? Are there any ISOs that have explored not treating the prices in the non-binding intervals the same as the actual price that is ultimately going to go to settlement?
So thanks, Alva. So that would basically mean that the objective function, instead of weighting all costs and all intervals equally, as Guillermo mentioned, is done in the MIO, you discount future costs and weigh present costs more heavily, which is consistent with some classic heuristic methods for dealing with risk, where you just discount the future more heavily than the present because you don't know what's going to happen. But I don't know of anybody who actually does that.
I thought Scott was sort of pointing to that as well in his marginal example. So.
Yeah, well, this is Scott Harvey. I work in a couple other jurisdictions that use multi-interval optimization. Ontario is actually the first system operator in North America to implement it, and they do explicitly their current system is a little bit funky in terms of their operator-defined periods rather than just every interval, but they do assign weights to the future periods. I can't remember them off the top of the head, but I've got it somewhere, and maybe we can pull it together for a future MSC presentation. And then the NISO is a little, it implemented the multi-interval optimization a little bit after Ontario, and it's not quite as sophisticated as the CAISOs because it doesn't treat every interval as 5 minutes. It has a mixture of 5-minute and 15-minute intervals, and the future intervals are 15-minute intervals. And what the NISO does, which in effect de-weights the future intervals, is each 5-minute interval counts as 1, and each future 15-minute interval counts as 1. So in effect, the 15-minute intervals count a third. All those 3 intervals count a third what the current interval does. So it in effect weights the current intervals more heavily than the future intervals. but not anything real sophisticated. But, that is something it does. The thing about the uncertainty is it cuts both ways. I mean, if the outcomes are distributed evenly around the mean, and it could be worse and it could be better, if you discount the future because it's less certain, well, it also the outcome could be worse. So, there's this reliability. I can see a reliability dialogue about, okay, yes, there's a wide range of outcomes for that most distant interval, but they could be if they could be both better and worse, what is the appropriate, weighting for the uncertainty?
Well, I think if you can keep the attributes of the solution that were present in those first set of scenarios, so that you've essentially guaranteed reliability, at least in terms of feasibility, then the question is going to be whether these are really reliability trade-offs that you're describing, or just a loss of efficiency. But I think those are really great examples. Thank you.
Yeah, I was thinking about this. I don't know how often these situations we got in the CAISO are driven by transmission limit changes, but if the operators have a practice of they change a limit and then they change it again and they move it around until they get what they like, the question is, should we then flow it through all the future intervals or not, if they know they're going to move it around? But I can see the case for they think they need to go to this limit on Lugo-Victorville, so they do it, and they want to keep it there for the rest of the optimization. But on the other hand, if they know they're going to move it around, maybe but I guess you could make the point, well, they might be moving it even further, so that it's better to set it up that's why it's just a hard question to think about what to do.
Thank you, Scott. I must admit that the description of what happened at MISO is rather hair-raising for me. It's easy to prove that, well, at least in a world without uncertainty, that will definitely raise costs. You'll do a lot more short-sighted things if you drastically discount the future. Of course, it's better than what they had before, where they just optimized one real-time interval at a time and didn't even look at future intervals at all. But it almost sounds like that somebody made a mistake and forgot to multiply by 3. But
yeah, I mean, you could argue that there were some reasons they didn't want to do that. I think I discussed this once, and there were some other unintended consequences of doing that. But then there's this other issue that Paul Grebnick has talked about, and I have, that it's related to the flexi ramp, is all of these things tend to over-optimize a little bit. And there's this issue of weighting the future too much, but maybe it's a different issue, but that's wrapped up in this, that all these multiple interval optimizations tend to, may balance you on the edge of a knife too much.
I think it is related, and it comes out more in the storage station.
Okay, thanks, Scott. Sure. Do we have anybody else on the phone lines?
This is Jim. I was just trying to jump in.
I don't.
Just to point out that we just looked at an example where there was something like a 238 10 intervals out that off-weighted a 230 something right now, and so there does seem to be some balance to be struck here about the bird in the hand versus the sort of prospective, distant, more optimal payout that would reflect the uncertainty there.
So I take what Scott said. I think it's something that should be taken quite seriously, that it could cut either way. It could make the system less reliable by overemphasizing near-term benefits. The real problem is not how much you weight the future. It's whether you're considering both the flexibility of the system and the range of possibilities. in a more stochastic way, and we're optimizing to a deterministic solution when the world isn't that way at all. And the answer is not necessarily just weight the future less, but it would be more comprehensively to consider a range of possibilities, which is, for example, what the deliverability constraints for the flexible RAM product is supposed to do, is to consider feasibility under alternative possible trajectories.
That's kind of what I was getting at when my comment about knife edge, that you can optimize something in the future that's just barely okay and doesn't consider the fact that if you're a little bit off, it's really bad. But because you're just, but analyzing, obviously we have enough computational problem solving 10 intervals, and saying that we're going to solve a probability distribution for those 10 intervals isn't really workable either, but that's would be, obviously a better outcome.
Yeah.
Or better design.
I'm not proposing it realistically now. So we are getting close to time. Fiora, was there another question? And if so, I hope it's a quick one.
I do not see any further callers in the queue as of now.
Okay, thanks, Shreev. Okay, Rahul, let's continue, and you may want to press on the gas just a little bit to get to any, if there's some bottom lines that you want to emphasize and get some discussion of.
Yeah, I think I'm going to maybe skip a few slides and try to go to exceptional dispatch because that's one topic we haven't hit so far. So can we go to the next slide? Yeah, I think this just emphasizes the counterfactual, and we just discussed that, one of the things is if you had enough state of charge, you could have seen a dispatch in interval 1. So let's move on. Can we go to the next? I want to briefly touch on this specific slide. This is the scenario that we had this morning from the LS slides, where the resource was being charged in 2 intervals because it saw an opportunity in the future horizon. And, this is the same example that I talked in scenario 4B, in which in the advisory interval, there was a high price, but that advisory price does not materialize. And the main reason the price does not materialize is there is a change in the conformance for a transmission constraint. So can we go to the next slide? So this just shows the same example, and it's showing that the black line, which was the advisory price, does not materialize in the binding LMPs, which are shown by the blue line. And to answer that question, the only reason it does not materialize is there is a change in transmission conformance. Let's move on. Okay, so this was a specific topic that we have heard questions about, exceptional dispatch and impact on storage. And just a brief overview of, when does the ISO use exceptional dispatch? So ISO uses exceptional dispatch for all types of resources, thermal resources, hydro resources, and most recently we have seen an use of exceptional dispatch for storage. And the storage resource exceptional dispatch is mainly used by the operators to make sure that the storage resources are full before the net load peak, so that it can be discharged when the sun is going down. And that's what our operators have been doing on days when the supply conditions are pretty tight. Can we go to the next slide? This is a slide that shows the trend of use for exceptional dispatch. As you can see, the exceptional dispatch for the entire year is pretty sporadic. It's not happening on regularly, but you do see some days when there is high load where our operators are using exceptional dispatch. Can we go to the next slide? So the key aspect for the current feature that we have in our market is, our operators have to manually calculate the charging instruction. So in order to decide the charging instruction, they have to know what the current state of charge is, what is the, if there is any derate on the maximum SOC, what is the charge efficiency, and also make sure that, we are not trying to charge the resource beyond the maximum bid-in state of charge. Can we go to the next slide? Give me one moment. Okay, so this was a specific example in one of the presentations that we have seen before, where a resource received an exceptional dispatch instruction for the evening time frame. And in this case, what our operators are seeing in hour ending 16, at the end of hour ending 16, that the maximum SOC for this resource is 364, and they see a room of 67 megawatt hours that can be added to this resource to ensure that it's fully charged for the evening net load peak. And what we see here is, there is a manual calculation that operators have to do based on the initial condition, the charging efficiency, and the maximum SOC. We should expect to see a fixed instruction to charge the resource at 79 megawatts for the entire hour for hour ending 17. Can we go to the next slide? What we observe is, instead of using a fixed exceptional dispatch of 79, we end up seeing a exceptional dispatch for 184. Now, because of this, much higher charge instruction than required, we ended up seeing some uneconomic dispatch. And most recently, we were digging into the scenario and trying to identify, why would we discharge the resource and then charge. We found that, there was a room for improvement in our software. There was a software issue that was discharging the resource in the current interval and charging it in future. We have found a way to improve our existing implementation, and so in future we believe that when we will use a fixed instruction to charge, we should not see this uneconomic dispatch. So we ran a specific case to identify what would happen after the software fix. Can we go to the next slide? So we took a specific case to figure out exactly what was happening. This is the time frame when we have an exceptional dispatch over the horizon. The initial state of charge was 297. There is the maximum SOC for this is 364, and we were trying to figure out what happens in the market if you ask the resource to charge more than its maximum SOC. Can we go to the next slide? And this is, what was observed. The resource is being dispatched out of money to be discharged in the current interval because it sees an opportunity to charge in future. We believe, this is a software issue, and that issue is fixed now, and we should see that in production maybe in the next update cycle. So can we go to the next slide? So from this example, you can see that, we have the original scenario and the rerun with the software fix. The original dispatch has the green bar in the binding interval in interval 1, where the resource is discharged, and then it's gradually charged in subsequent intervals. After the software fix, the counterfactual dispatch that's shown by the purple bars is showing that only being charged from intervals 1 through 6. The rerun SOC, which is shown by the orange dot, shows that once it reaches the maximum SOC of 364 in interval 6, it's no longer being charged or discharged. So I believe with this software fix, we should not see this unexpected outcome related to exceptional dispatch. Can we go to the next slide? Okay, so I'll hand it over to Guillermo for the closing remarks.
Go back then one, this is Scott Harvey, on that last picture and this new fix. Before, I just want to understand, it looks like maybe the new fix is where the exceptional dispatch is going to, even though it has 8 or 9 intervals to fill it up, it's going to automatically do it without regard to price in the first 5, and then get it full as fast as possible. But I can see that having unintended consequences of, suppose we actually get it spiking to $1,000 in 2 of those intervals. We would continue charging even though we don't want it to, and we actually have 9 intervals to get where we want to go. So I'm not sure this is a step forward if that's what we've done.
Yeah, I think there are 2 aspects to exceptional dispatch. If we use the right amount of fixed charging instruction, that should align it the way we want it to do. But I do agree with you that if we have an exceptional dispatch that's more than what we can charge the resource over the horizon, it would still result in uneconomic unintended consequences. But for that, I think we'll have to go back to the drawing board to see if there are any other ways of solving over the horizon.
Couldn't you just put in an end of period state of charge and then into the software, and then it would do it the most efficiently, and it wouldn't, as long as it could get to the state of charge by the end of the hour, it wouldn't interfere with balancing if something bad happened early in the hour?
So that's the one of the discussions that we have internally right now. First, we are only have the tool to use a fixed megawatt instruction for managing the state of charge. In future, we are looking for enhancement where we use the exceptional dispatch for future. We just are looking for an improvement to use state of charge exceptional dispatch. But I don't think we have the design or implementation yet.
Thanks.
Okay. If there are no other question, I can summarize the last slide. Can we go to the last? Okay. So, just to summarize the ISO's presentation, the multi-interval optimization provides the means to position the system for future horizon. The multi-interval optimization just poses challenges for certain dispatch, but if we don't have multi-interval optimization, we would have a different set of challenges. And dynamic system conditions or uncertainties are inherent to the real-time market operations. So we will continue to see some effect of uncertainties in real time, and I think the rooms for improvement are there, some in the software, some in the procedures and process, and I think that's where we will take it in the policy discussion to figure out what the solution should be for these kind of scenarios. I think that's all we have. So I will hand it over
Thank you.
to.
Thanks, Rahul. Thanks, Guillermo. So we're at time, but let me check first of all with the MSC members, and then on the phone line, see if there are any last questions or comments. First, Jim and Scott.
More comments from Scott.
Nothing from me either.
Okay. All right. Well, let's see. Anybody on the phone line, Shriv? At this point,
I do not see any. I'm sorry. Go ahead, please.
No, I was just going to say last chance. If anybody wants to make any last comments, particular questions on this, or more general comments, we welcome them at this time.
As a reminder, if you're connected to the computer audio or use the Call Me feature in WebEx, you may enter the question queue by using the WebEx raise hand icon located just above the chat panel. You'll hear a beep tone when your line is unmuted. At that time, please state your name and question. If you're just on the phone line and not using the WebEx audio, please dial #2 on your phone to enter the question queue. You'll hear a notification when your line is unmuted. At that time, please state your name and question. I do not see any callers in the verbal queue as of now.
Okay. Well, that's great. So I think then we are done. As Gabe mentioned, there will be another storage meeting at the end of the month, a more general panel addressing a range of issues. And we are also scheduled to have an MSC meeting late in the month as well, which will be addressing, and we're not sure what's on the agenda yet, but there are several important issues facing the ISO, among which, of course, is storage enhancements. So our agenda is done, and I wish everybody a good weekend. And Shiva, we can now close the phone lines.
Sure. That concludes our conference. Thank you for using event services. You may now disconnect.